Good evening and welcome back to the latest edition of the InvestTalk market analysis for the week ending April 5th, 2024. This week I'm going to title the video Gold's All-Time High, Geopolitics and Jobs. And that's what is really sparking the market higher. And some of it is intuitive, some of it is counterintuitive. Now, the geopolitics is obviously intuitive. Uh, or the U.S. has said Iran is going to uh, retaliate on Israel in the next week or so, and that certainly brings some potential trepidation to the markets and a flight to safety. And gold tends to be one of those. And then there's the jobs market, and the jobs data was good, and that ultimately, frankly, is something I think is sparking the gold rally as well. And what you can see here is the Fed dot plotter, the Fed, the pricing in of the Fed moves by the year end has kind of started to coalesce around 2.5 cuts instead of three. And that seems like, okay, we're at 6 to 7 going into the year. The market has moved in a more hawkish direction. That should put a rally in the dollar. That has, but it has not quelled the rally in markets. And I think a lot of that has to do with the strong economic numbers, which let's get into right now. Tuesday we had the durable goods new orders. That one had a little tick higher, still, subdued from last summer's highs, but overall, over the long term, still in a solid uptrend. The PMIs came in on Wednesday. The broad number was still growing 51.4, but a tick down. And this is the services number. So this is the majority of the economy here. So a little bit of slowdown there, but the employment index that did improve a little bit, although still in shrinking territory. But most importantly was the prices paid index that moved down to 53.4. So that's something I think the markets liked, or the Fed would like, right? And then you have the continuing claims that was on Thursday. That ticked down, so that shows you, maybe the jobs market is a bit stronger than you would expect. Average hourly earnings did tick down a little bit on the jobs report. And then on Friday, the jobs report, 303,000 jobs, definitely beat expectations, raised the numbers from the previous months as well. So it was a very rosy jobs picture on Friday. The unemployment rate dipped from 3.9 to 3.8, and all of that once again brought the average expectation for rate cuts this year to 2.5. Now, I will caveat this with saying this is not nearly as important as all the other things both the Treasury and the Fed are doing. The Fed is doing two things right now, or looking to do two things over the next 3, 6, 9 months that are far more important than this. Number one is the winding down of QT. I've talked about that, the rising or shrinking of the Fed balance sheet. That's going to be, frankly, more important to liquidity than this. Okay. Yes, interest rates are important. Yes, interest rates matter, but they matter mostly to the the part of the economy that is very interest rate sensitive. And you've seen with this big rise in rates over the past couple of years that there are only so many parts of the economy that are that interest rate sensitive. Okay. And so, yes, this is important, but what's most important is the liquidity that's out there. And Fed balance sheet going up or down, that's more important because liquidity affects broader markets and feeds through to kind of every industry, because every industry needs liquidity, valuations need liquidity, etc. Okay. So that's number one that the Fed is actively looking at doing. Number two is what is called the buyback program. Now they're launching this. They're going to do a couple hundred million in buybacks, which frankly means nothing. Like 200 million in the grand scheme of a treasury uh, market that is worth 25, 30 trillion dollars is nothing. But what it is hey, they are getting closer and closer to maybe broadening out this at some point, getting it ready as a tool for them if the treasury market gets dysfunctional. And I think those two things are far more important than this. So I wanted to caveat this discussion about rates with that on the Fed side, and then the treasury. The Treasury is important because they have the Treasury General account. What are they going to do by letting that draw down? That's going to put liquidity into the system if they let it draw down, or do they issue more treasuries, pull liquidity out of the system, et cetera? And then where are they issuing on the curve? Are they issuing long dated securities or short dated securities? And right now they're leaning on the short dated securities. That helps liquidity. If they start to issue the longer dated securities over this quarter, that would pull liquidity out of the market. So I really wanted to touch on that because it's so important to uh, focus on that as opposed to all these other things that get headlines, but at the end of the day, don't matter as much. Okay. Um, let's see. What else do I want to get to? Yeah, let's get to the charts. Let's get to the charts. Let's start off with gold. Start off with gold here. Gold prices at an all-time high. Here's the GLD. This is a strong breakout. Now it's a little overbought, but it's been overbought now for a little while, right? And you see this consolidation period before a move higher. This is your classic bull flag. Just chopped sideways for a couple weeks and broke out once again. You're probably getting to a point where that's need to be done again. But I'll zoom out here and I'll show you this reverse head and shoulders here. Okay, you had a head, you had two shoulders, and you had a breakout here. And ultimately, from wherever that breakout is, that gives you a target way up here. So I think there's more upside for gold prices in the short to medium term, but long term, I think it even has even more upside, up over $4,000 an ounce. Just so much money flowing there from the east, and I say east, I'm talking about India, China, Russia, and then wait until the meme stock people get a hold of it and start trying to trade it like Bitcoin, right? So I think there's definitely a potential upside for gold going forward. Oh yeah, I I want to talk about the jobs before I get into this any deeper. The fact that the jobs number was so strong, it tells you that there's not a lot of deflationary impulses in the economy. And so if the Fed is thinking about not raising rates to quell maybe a resurgence in the broader economy, the ISM manufacturing index that came out strong last week, all of that along with the jobs number saying this economy is reaccelerating, and the Fed's thinking about cutting rates, it doesn't square. And so what it means is that the real rates, when you take the nominal rate minus inflation, could be heading negative. And that's what gold is kind of telling you. In addition, so that's the geopolitical and the job side that is driving gold to new highs. And you can see with the surge in gold, you're seeing oil go up as well. So here's the USO, here's the XLE. Look at the materials sector, right? That's strong. Here's IYM. You could see, let's look at Freeport McMoran, right? That one very strong. So that's the largest copper miner in the world. So there are a lot of materials, a lot of base materials that are doing very, very well right now. And all of that is eventually going to feed into inflation over the next 3, 6, 9 months. And so I think that's another reason why gold continues to go up and why the 10-year continues to dribble higher. That's really what it is, right? It's not a strong move higher, but it's definitely been in an uptrend for pretty much the entire year. Since January 1, you had that little dip in late January, but ever since, you're just getting a series of higher lows and higher highs. That is an uptrend. And as the economic data comes in a bit stronger, that's where that's why this is trending higher. Now, I don't think the Fed is going to allow this to break out, and the move index is kind of showing that the liquidity is out there. There's enough private balance sheet to sop up the current Treasury issuance for now. And I'm sure the Fed will continue to watch the move index to see if there's any problems that do arise. But right now, you're in a situation where liquidity is abundant. Yes, rates are going up, but it's not really breaking anything. And the S&P did have a sell-off on Friday, Thursday, and I will say that is something to watch. This is the new line in the sand in markets. This is a day, although not huge volume. Let's go over to the SPY. Let's see what the volume was on SPY. Yeah, I mean, that's probably the saving grace of this is that you didn't get massive volume on Thursday. It was elevated volume, but we've had many more days that have had better volume than that. Let's look at the Qs. Same thing, right? Look at the Q volume. Nothing too crazy. Let's go to the COMPQ, the Nasdaq Composite. No, that's not showing that. NYSE. Yeah, no volume data there. But basically, let's go to IWV. This is Russell 3000. Yeah, not huge volume there. So while from a price perspective, this reversal on Thursday was interesting, it didn't get follow through on Friday. And until we get follow through, it was just kind of a 1 day thing. You had that back here on January 31st. And what happened? The rally continued. So it certainly could continue. There's definitely a line in the sand here, like I said, at this high from Thursday. See if we close back above it. If we do, this is just a blip on the chart, just like it was back in January, this little sell-off day in early March, etc. All of those are just a little bit of near-term market gyrations. So just wanted to highlight that. Definitely down on the week. It was a negative week. Let's go to a weekly chart here. And we're overbought. And to have an above average volume week, we didn't close below last week's low. Or did we? Let's see. Let's see. I haven't looked at this yet. Ooh, that's close. Yeah, it doesn't look like we did. The low from last week was 51, 518.40, and we closed at 518.43. Yeah, there we go. So we just by the skin of our teeth closed above last week's low. Let's look at the SPX. As you can see, this looks a little different on the SPX versus the SPY. Let's see, same thing, low 52.03.42 and closed 52.04. Yeah, 4. So yeah, we're fine. From a technical basis, it was just a little bit of a down week, nothing too crazy, not super high volume, nothing really to worry about. We're in an uptrend. Now, could we go through a consolidation period? I think that's certainly possible as well. You could go into something like, let me go to a daily chart here, like this, where you go sideways for about a month. That's what we did in mid-December through mid-January, right? This is just a choppy period. Obviously, had a lot of gyrations with year-end profit taking, tax loss selling, etc. And then the market took off from there. We are getting into the tax season. We have about 10 more days until taxes are due. You have people selling off assets in order to pay for taxes, and that can kind of draw liquidity out of the system, at least in the short term. So just wanted to highlight that. You had the dollar, was down a little bit on the week, but mostly flat. So nothing really to worry about there, at least in the near term. But I am starting to see everything lining up bearishly for the dollar. And that's what's even more interesting about this move in gold and now silver. Silver has joined the party here. Is all of this has moved, oil, gold, copper, etc., without the dollar getting any traction to the downside, right? So imagine if the dollar does get traction to the downside. I think these things are going to continue to rip and roar. So I wanted to highlight that part. Let's see, is there anything else I wanted to get to? The VIX is always something to be on watch for. That did spike up this week. Obviously, geopolitical tensions on Thursday were a reason for this, but we'll definitely see how it goes. Right, we're here in the weekend. I haven't seen anything yet across the news of any major retaliation, but could happen in a couple weeks, in 3 weeks, and that could be the spark for another sell-off in markets. But for now, liquidity remains robust. I wouldn't shock me to see a consolidation pullback period in the S&P or just broader equities. If you look at things like the short-term treasuries, the short-term junk this ratio, it has moved down. It broke the 50-day moving average. So that is probably the first that's probably the first message that, hey, this could be real, that there could be a modest risk off scenario that brings the market down 5, 7, 8% from its highs. And but I think that's about as bad as you can expect it to be in this environment of strong liquidity, strong economic data, strong earnings, etc. So, um, yeah, don't get overly bearish. I know the market's overbought, but usually, markets don't crash from all-time highs. I say this all the time. Everyone thinks the market's going to crash. Markets do not crash from all-time highs. Okay. You can go through a pullback period, a topping period, topping formation, etc. And then over time, the market weakens and you go through a really protracted downturn. But that's at least many months off, right? But near term, like I said, a cooling off period would not shock me. All right, I think that about does it. I appreciate you all tuning in, liking, and subscribing to this channel. And a reminder, the content of this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a wonderful weekend.